Hey guys, what is up? It's Arthur here and welcome to this video in which we'll be taking a look at LendingClub, ticker symbol LC, as one of you guys suggested in a previous video's comment section. So if you have another company you would want me to take a look at and go through together, leave a comment and we will make that happen. So again, in this video we're taking a look at LC. If you don't know what LC is, we can go to Market Watch's profile section and it tells us that LendingClub engages in the operations of a digital marketplace bank. It operates through this and this company. Let's see, provision of full complement of financial products and solutions, loans, leases, and deposits. The LendingClub Corporation, the parent only, includes the S. Okay, so I don't think that's a lot of information. We can go to their website. I scrolled and skimmed through it. Again, guys, you suggested to analyze this company, which is a financial company. Now I had to do some work on my Google Sheets so that it can handle negative numbers better. And boy, is that a foreshadowing. And so I don't usually do financial companies because they report their financials in a different format. And I'm just not that familiar with them. So we're, as always, just taking a bird's eye view on this company. So if you know more, educate me. I'm not into financial companies and I don't see anything super striking of what would make this really stand out. But again, it might just be my shortcomings to help me out on this one, guys. What's the background story with LendingClub? And so, if we're gonna get started on this, we're gonna take a look at just how big this company is. The market cap is 1.15 billion. I think it's by far the smallest company that we have looked at. I think the second would be UHS that we just covered in the previous video. And this is, well, just look at the dashboard first. Market cap of $1.15 billion. We can take a look at the enterprise value, which just takes the market cap plus the debt minus the cash, because I guess you can get debt anytime and you can just put cash into a business. It wouldn't do anything. So if you do that, this company is really worth like $380 million. So that's peanuts. Now, small companies have a lot of room to grow big and then earn those great returns. But the problem I see right up this dashboard is that free cash flow, so the cash that the company has left over at the end of the day, in the last 12 months, they lost $2.2 billion. And like, I think that's a really big problem just right off the bat, because you can buy this whole company for $400 million for what it's worth, and it's gonna lose you 5-6 times the amount in just 1 year. So it's not looking good as a start. We can also see that the highest this company was worth is $140, which I guess was at their introduction to the stock market. I'm just gonna refresh this chart real quick if it does. But in the meantime, we can see that gross profit is not present because I think they report their income statement differently, and so there is not that. Profit margin is there, however, it is down from the 5-year average. So it might be more competition, it might be more expensive operations, something's going on that resulted in a slightly smaller profit margin for this company. We do not have any dividends, so we don't have to care for that. Augmented payout ratio, it's basically 0, so there are no share buybacks and no dividends. They are not buying any companies, and just by the looks of it, it's probably gonna be just a downward trend that I'm seeing from it. Yes, we did get the update. So it looks something like this. It has really settled in this range. I don't analyze graphs and I don't recommend you to take a look at it. I just wanted to show it that compared to what this company was worth, I don't know what kind of hype this was about and what happened here around like the end of 2021. I might be coming off the pandemic and something to do with the interest rates. I'm not sure. But we have this 10 item checklist on the right that you can see here. We're going to go through these and see how LendingClub measures up, and we can talk a little bit more about what those numbers mean. So right off the bat, tiny company, but we still want to see whether revenues over the past 5 years managed to grow. So we're going to go into their financial statements, and we're going to go income statement. Right off the bat, first line, we went from 570 million all the way up to 1.32 billion. This is very nice, and it is a check mark. It's a nice and steady growth, actually. So I like to see that we are up 130%. So that's nice to see. Next thing we want to see is net income. If we deduct all the expenses that they occurred while making this top line revenue, what are we gonna be left with? We went from actually a loss of 180 million to 51 million, which is a check mark. It has been higher. We have been to 300 million roughly, but we are making these amounts. All right, I also calculated the average of that, which we're gonna use in the next step. So the average is $42 million that they managed to bring in every year on average. And now that we know that, we can take the market cap, which you can find in the overview as well, just market cap, and we can take this, how much it costs you to buy this company, the whole thing outright, and then you're going to divide by the average, and that is going to give you 27.25, which is your PE ratio. Now this means that if you compare the price for the whole company with the earnings that they are capable of producing, it is going to take you 27 years to make your purchase amount back. If you think about you buying the whole company, it takes them 27 years to bring your money, to make your money back, which we would like to be under 20, because it is a sort of common rule of thumb that anything below 12 should be cheap, around 15 to 18 fairly valued, over 20 is where it gets expensive, but different industries have different sort of ranges. So what I introduced is that I want to take a look at how the competition is doing, because this is just looking at this company. There could be turbulences, although we take a look at the 5-year average, so then it is a bit more smoothened out. And so, oh yeah, we want to go here to Trading View, which is a lovely site. I love to use it. There are these breadcrumbs on the top, and if we go back to like the niche topic, it's gonna list some of the competitors, and there is a lot in the case of LendingClub, so a lot that we can look at. But what we are interested in is the PE column, because I take this and I find the middle value. If you put them in an increasing order, you take the middle value, and I think that's going to represent the competition. So then we're going to see that, and it's going to tell us that the median, the middle value of the competitors, is 12.35, which is an X. So this is going to give you an idea of how expensive or cheap LendingClub is relative to the competition, not just looking solely at the company, but taking a broader view and having some sort of reference point. So it is more expensive than your sort of average company you could find and in this financial banking sectors. Now the next metric would be return on invested capital. We cannot really put that into numbers because they report their financials differently. So the lines, the lines of items that I use in that calculation is not there. This is not an official metric, return on invested capital. You might find some sites that would report this. So we can take a look at MarketWatch. They might use a different formula, but you can get different numbers on this. Return on invested capital, 3.86% in this case. Now the market average is around 9 to 10%. I tend to look for more than 10 just so it's nice and round and we get a little bit extra on it. But this is below 4, so you're not really getting, they are not really getting a good return on any money that gets put into this business. And if you were to buy shares, you wouldn't get either. So that would be an X in my case and in my book as well. So next up, one of my favorites, we're gonna look at the number of outstanding shares, which we would love going down. We can find it in the financials. Still income statement, because you make the money, you deduct all the expenses, what's left, and then how many ways you have to split it with the owners. We're gonna use diluted shares, which is the potential maximum number of shares. And we are down. We're actually up, so this is a negative thing. We're up from 90 million to 113 million, which is a 25% increase. This is a massive X in my book, and I would probably be out at this case. Now, there is a lot of things that we can deduct from the number of shares increasing. The first is the implication of this. Now, if you were to buy a share right now or any number of shares, within 5 years, if they keep this tendency, there would be 25% more owners in that business, which means that you would get smaller and smaller pieces of the pie or the pizza. So all the profit that is being made in net income is going to be split among ever increasing number of owners. So you're going to get less and less and less unless you buy shares. This is not a good thing. This is called dilution. They are making you a smaller owner of this business. So we don't like that as investors and owners of businesses. What this also means is that a company raises money when it issues new shares on the stock market. This is one way to get money into the business, but as I explained earlier, it is going to hurt owners who have already purchased shares. And companies might do this. They might issue new shares when they think that their company is overvalued, so they can get a better return. They can get more money for issuing shares, issuing new shares. The opposite of this would be that if this number was decreasing over the years, which would mean they are buying back the shares, which would indicate that they are thinking, hopefully would indicate that they also see the company as undervalued, and it's a good way to spend money just buying back their own shares and making owners bigger in that sense, making them hold more of the business because there are decreasing number of shares. That we'd love to see. This, not so much. This is a very big X in my book, but it might be different for you. I don't see a spin on the story where diluting you is a good thing. So I would step back here, but let's keep going and see what we can dig up. Next up, I want to take a look at the rate at which their total long-term liabilities have been growing, how much debt they are taking on, and how much they are able to convert that into increasing their revenues. Now, long-term liabilities you will not find as a direct line item. It's going to be in the balance sheet where you talk about the assets and the liabilities you have, basically what you have and how you can afford that. These are the two sides. If you want more explanation on that, we can make a separate video on that. Just leave me a comment. So we're going to go down to, this is again a different balance sheet. We're going to go into the balance sheet, but this is a financial company, so this is slightly different than a standard company or most of the companies, the way they structure their financials. What we know is there is total liabilities, and that is made up of two things: total current liabilities and total long-term liabilities. Now, we could see that there is total debt, and it is broken down into short-term debt and current portion of long-term debt. Short-term is what's going to happen in 1 year, long-term is anything above that. And if you see, other items are long-term and then deferred and so on. So I think we could just take this and deduct it from the total, so you would get long-term liabilities. That's what I did, and this is gonna give you, you're gonna again do that for every year, compare 2020 to 2024, and you would get that the liabilities increased 800%, so we 9x'd our liabilities, but we could only like 2.3x our revenue. So that is an X, unfortunately. As you can see, total liabilities grew rapidly, and then they couldn't really translate it to really increasing the amount of money that they can earn. Now, and this is interesting because they, on their website, said that how is LendingClub different? I think I read it here, is that, yeah, sure, they are a leading digital marketplace, yada yada. What I saw, yes, because we don't have any brick and mortar locations. So now, then I would be really interested in what they needed all this loan for if they don't have physical stores, because we know like scaling digital solutions and apps is very, very cost effective, because you have to make the code once and then you can basically have all the people download it, simplified, but you get the idea. You don't have to maintain all that physical space. So you would really want to look into what these loans are for and what's the idea behind, what's the plan behind paying these off. Because next up, what I want to see is their 5-year free cash flow, whether that has been growing and how much, because free cash flow they can use to pay off debt, among other things. Why we like free cash flow is because it can be used for 5 different things. They can reinvest in the business, they can buy other companies, they can pay down debt, they can issue dividends and buy back shares, 2 of which we know they are not doing, so that they're also not buying any companies. So all the free cash flow that they would make, they either reinvest in the business or pay down debt. Those are the 2 things that they are doing. How can you calculate free cash flow? You can take net operating cash flow, and then you're going to add the negative value of capital expenditures. So this is looking a little bit rough, but Market Watch does it for you. You can scroll down and there is free cash flow. And so we can see that we went from 387 million down to losing 2.7 billion dollars. This is what I hinted at the very beginning on the dashboard. In the last 12 months, losing 2.2 billion. It's not any better. It's even worse in the financial year. So yeah, this is kind of even in 2020, 2021, 2022, and then something big happened in 2023, and you want to find out, look at the lines above to figure out where all these losses came from. Because if you remember, our liabilities grew rapidly, coming closer to today, and then this is the time that we are losing free cash flow. This is going to really put them in a situation that it is going to be hard to pay off those loans, although they are a digital company. So it is again then interesting how they could get so many loans, because you don't really have the collateral to put up with like next to a debt. Because if you have brick and mortar stores, you know, if you default on the loan, you can give one or two, you know, you're gonna sell one or two locations, you get money for it. Banks are more likely because there is collateral behind that loan. But with a digital company, there aren't really a lot of assets usually that you can put up as collateral if you default on the loan. So you would want to look into this. What's the plan here? Because increasing your debt and losing a very large amount of cash flow, free cash flow, I don't think goes very well together. But the next two metrics that I look at uses the free cash flow value. Now the average is losing 600 million every year, and that is just not something we can calculate with. So those are two other axes, because with a negative free cash flow on average, you cannot really pay back your loans. So minus 15.5 years doesn't really mean anything here. You would not be able to pay back the loans. That's just it, with a negative cash flow. So this really needs a solution. And then what I also normally do is that you take the free cash flow value and then you divide the market cap by that, so you can see how many years it would take for the company to make back your purchase in terms of free cash flow, which you can then use to reinvest in the business, buy others, etc., etc. Just, you know, making more with your money and earning a return in that way. So unfortunately, LendingClub earns a 2 out of 9 because we could not give it a return on invested capital score. We saw it was 3.86. So that's another X. So we could make it 2 out of 10. And unfortunately, with a negative free cash flow, there isn't much meaning to doing a discounted cash flow analysis, because just taking the average of the past years, it is gonna be a negative number. And at that point, I'm not sure if you really want to project that into the future. You could, but I think time would be better spent on looking at companies that are already producing some form of free cash flow, which I think is the more important thing to look at. And so that's what I base a lot of my decisions on. Also, another thing I would like you to take a look at is that their net income, which is how much they make on paper, basically, 42 million on average, 51 million in the last 12 months, trailing 12 months. However, as we discussed, they are losing $2 billion in cash. So these values are very far off from each other. So pay attention to that. So even though it might look like they are making some money, they are actually losing a lot. Like they are losing twice or 5-6 times as much as the whole company is worth. So there might be growth potential here. For me, the numbers just don't add up right now, and I would be more cautious with this company. I hope it was helpful to you. If you have any other companies that you think we should take a look at, leave them in the comments and we will sort it out. Thank you for your time. I hope it was helpful, and I hope to see you in another video. Bye.